Hello my dear friends, in today's video we will review chapter 7, Market Power. In this chapter we will explore one of the most fascinating areas of microeconomics, imperfect competition. Unlike perfect competition where firms are price takers and markets operate efficiently, imperfect competition reflects the real-world dynamics of power, control, and strategy among firms. We will analyze how different market structures, monopoly, monopolistic competition, and oligopoly influence prices, efficiency, and overall welfare. By the end of this lesson, you will understand not only the theory, but also how these models explain the behavior of firms in actual markets. When a producer makes something, it gets revenue. So, total revenue is the money that a company receives when it sells something. The formula is the price of the products multiplied by the quantity. As for average revenue is total revenue divided by the quantity or revenue per unit sold. Marginal revenue is the additional revenue of producing additional units of output. So the formula is the change in total revenue divided by the change in the quantity. Looking at the graph, we see that total revenue, marginal revenue, and average revenue graphs. So when total revenue is at its maximum level, marginal revenue equals 0. Moreover, when marginal revenue starts to increase and is more than 0, so it means that it earns positive revenue. However, when total revenue decreases, marginal revenues start to be less than 0. So here are all the formulas for revenue. You can pause, rewrite, or take a photo. Moving to the next point, there are also the costs of producers, which are the inputs or resources to produce something. Costs of producers are total costs, fixed costs, and variable costs. Total costs are pretty simple. It is the sum of fixed and variable costs. Fixed costs are costs that do not vary with the output produced. For example, it can be rent and electricity. However, variable costs are the costs that vary with the output produced. The examples are labor and resources. Here you can see three curves where fixed costs are static and horizontal line and do not vary with the output produced. Variable costs are increasing with output produced, and total costs are increasing from the point where variable costs start. Moreover, there are average costs of the firms. Average costs are divided into average fixed cost and average variable costs. So average total costs are the total cost divided by the quantity and reveal the cost per unit of output produced. Average fixed costs are the total fixed cost divided by the quantity and show the fixed cost per unit of output produced. And last but not least, average variable cost, which are the total variable cost divided by the quantity. And of course, show the variable cost per unit of output produced. Here you can see all the graph. You can see three curved lines. Don't forget to redraw it, because later on we will use it. Marginal costs are the additional cost of producing additional units. The formula is quite easy. It is the change in total costs divided by the change in quantity. To simplify, marginal costs reveal how much cost I will have if I want to produce one more unit. Here on the graph, we can see that there is a marginal cost curve. And remember that it is an umbrella handle and the average total costs. So marginal costs always intersect average costs at their minimum level. Here are all the formulas for all types of costs. Pause, rewrite, or take a photo. It is important. So let's imagine I have already built a huge production and want to earn more. So what do you think? What should I do? Increase the price? No. I will lose my loyal clients. Make marketing campaigns? Yes, it can work, but who knows? The most efficient way is to decrease the cost of production. In economics, it is called economies of scale. Economies of scale are the concept that explains the decrease in cost due to an increase in the level of production. So here in the graph, you can see that the company can decrease the costs only if it increases the volume. So do you know the reasons for economies of scale? Mostly they are specialization of labor, lower prices for inputs, and financing economies. Moreover, we can see that economies of scale happen only in the long run rather than in the short run. As we move along the long run average total costs, however, also here there can be diseconomies of scale. What is this? Diseconomies of scale is the same concept, but by increasing the quantity produced, the company faces higher costs. So why it happens? So the reasons are poor worker motivation, difficulties with organization and monitoring. We have done with revenue, costs, and what can be else. So the next is profit, which is simply the difference between total revenue and total costs. Here is the formula. So besides in IB economics, we have the concept of profit maximization, which reveals how companies in perfect or imperfect competition set prices. It is based on a rule where marginal revenue equals the marginal costs. On the first graph, we see that marginal revenue is horizontal and the companies cannot control the prices at all. That's why it is the perfect competition market structure, where firms take the prices as given on the market. On the second graph, we see that marginal revenue is downward sloping, where the firms set prices and do what they want. So it is the illustration of imperfect competition, where actually marginal revenue is more than marginal costs. Furthermore, any company produces goods with the given inputs. How much it can produce is called the total product. Total product is actually the quantity of goods produced in a given period. Marginal product is the additional quantity produced by using an additional unit of input. Average product is the output per unit using a particular input. As you can see on the graph, there are three curves: total product, marginal product, and average product. So we have 4 stages. The first stage is when the total product increases and the marginal product increases. The second stage is when the total product increases at a lower rate and the marginal product decreases. The third stage is where the total product reaches its maximum and the marginal product equals 0. And the last stage is when the total product decreases and the marginal product is less than 0. It is important to note here that based on the graph, the marginal product can be more, equal, or less than the average product. When the marginal product is above the average product, the average product starts to increase. When the marginal product is less than the average product, the average product starts to decrease. And when the marginal product equals the average product is at its maximum. So markets promise efficiency, but power corrupts. When one firm dominates, competition dies. But do we have clear and fair competition? Yes, we start with perfect competition. The characteristics of perfect competition are a large number of firms, homogeneous or identical products, no barriers, and no market power. The example is the agricultural sector. In perfect competition, we have 2 side-by-side graphs of the individual firms and the industry. Here in the graph, we see that for the left side graph, it is an individual firm, and for the right side graph, it is the industry. As for the firm, the horizontal line is marginal revenue, price, demand, and average revenue. Why? What do you think so? Because the seller in perfect competition cannot set the price, and therefore marginal revenue and average revenue will always be the same. We can conclude here that the seller takes the price at it is given on the market. You can ask, okay, we got that there can be two side-by-side graphs, but how can we find the price equilibrium for the firm? In order to find the equilibrium price and quantity, we have to find the point of intersection between marginal revenue and marginal cost. And as you remember, it is called the profit maximization rule. There are two periods during which perfect competition can operate: short run and long run. In the short run, a perfect competitor can earn normal profit where profit equals zero, abnormal profit more than zero, and loss profit less than zero. On the first graph, we see an abnormal profit graph in the short run. Firstly, we find the point of intersection, marginal costs and marginal revenue. Then we're going down till the minimum point of average costs and then go left and see that the whole area, green area, is the profit for the firm. On the second graph, we see a loss graph in the short run. We do everything the same steps and we find the point of intersection, marginal costs and marginal revenue. Then we're going up till the minimum point of average costs and then go left and see that the whole red area is the loss for the firm. And on the third graph, we see normal profit where profit equals zero in the short run. We find the point of intersection, marginal costs and marginal revenue, and we already see that profit equals zero. Moreover, it is important to take into account this graph. We have here marginal costs, average total cost, and average variable costs. So when price equals the marginal cost and the average total cost, we can call it as a break-even point, where profit equals zero. When price equals marginal cost and average variable costs, we can call it as the shutdown price. Therefore, we can also conclude here that starting from the shutdown point or shutdown price and up further, it is a supply in the perfect competition. Thank you for watching. Subscribe and stay tuned. Bye bye.